Okay, picture this. How do you value, buy, and then pivot a multi-million-dollar business? Honestly, it's the ultimate high-stakes puzzle. It's the kind of thing that definitely causes a few sleepless nights for CFOs. But it is also a skill that every single top-tier financial professional absolutely needs to master.
Welcome to The Explainer. I am so pumped you're joining us because today we are completely demystifying advanced financial management. We're going on a corporate deal journey. We're going to break down some of the heaviest, most complex areas of the ACCA AFM syllabus. We're talking business valuation, mergers and acquisitions, and real options. And we're going to do it in a way that actually just makes sense.
All right, so here is our game plan for today. We'll hit the AFM deal lifecycle, valuing the target, mergers and acquisitions, structuring the payment, the power of real options, and then finally, we'll wrap up with your strategy for exam success. Okay, let's jump right in with Section 1, the AFM deal lifecycle, acting like a chief financial officer. Now, before we even think about diving into the heavy math, let's just ground ourselves in what we're actually doing here. Advanced financial management is not just some random collection of disconnected formulas. It takes your basic financial principles and pushes them into complex, real-world scenarios. I want you to think of this as your practical toolkit. You are the CFO navigating a massive corporate transaction. You're not just crunching numbers. You're the one making the big, strategic calls about multinational investments, corporate restructuring, and dealing with risk. Moving right along to Section 2, valuing the target company. This is Phase 1, knowing exactly what it's worth. Listen, before you can even entertain the idea of buying a business, you literally have to figure out its exact price tag. But there is a classic trope here that trips up so many people. When you're using discounted cash flow to value a target, you've got two very distinct paths. First up, free cash flow to firm, or FCFF. This is the cash available to everyone. We're talking debt holders and shareholders. And because it's for everyone, you discount it at the weighted average cost of capital, the WACC, to get your enterprise value. Now, on the flip side, you have free cash flow to equity, or FCFE. This is the cash left over strictly for the shareholders after all of the debt obligations are taken care of. So you have to discount this at the cost of equity, KEE, which gets you straight to the equity value. Mix these two up? Yeah, your valuation is going to be completely off. Let's actually walk through with the sequential steps for the FCFE method to sort of visually break down the math and shake off any formula anxiety. Step 1, forecast your free cash flow to equity. Keep in mind, this is your profit after tax, plus depreciation, minus capital expenditure, minus the increase in working capital, plus any net borrowing. Pew. Okay, step 2, discount those forecasted flows at your cost of equity, KE. Step 3, add in your terminal value for all those years beyond your explicit forecast period. And step 4, boom, your result? That is your exact equity value. And the best part, there's no need to subtract debt at the end like you have to do with the firm method because you already took care of it in step 1. But hey, cash flow isn't the only game in town. Depending on the target, you've got a few other models you can deploy. The PE ratio method is awesome when you have comparable market data. You just take the maintainable earnings, make sure you completely strip out any one-off non-recurring items, and multiply it by an appropriate PE multiple. Now, if you're dealing with a holding or investment company, the asset-based method, looking at realizable value or replacement cost, totally makes sense. And for those mature companies with super stable dividend policies, the dividend growth model is a fantastic tool. Basically, your choice entirely depends on the nature of the target company.
All right, Section 3, mergers and acquisitions. Phase 2, unlocking synergy.
So you valued the target and now you want to buy it. But why? Well, it all boils down to creating entirely new value. This is literally the entire driving philosophy behind mergers and acquisitions. 2 + 2 = 5. This, my friends, is synergy. It's this incredible idea that the combined entity is going to produce incremental cash flows that are tangibly greater than just adding the two standalone companies together. Honestly, if 2 + 2 only equals 4, there is absolutely no reason to go through the massive headache of a merger.
So where exactly does that magical extra 1 come from? Well, CFOs justify the massive premiums they pay for a target by hunting down specific types of synergy. You've got revenue synergy, which comes from stuff like cross-selling your products to a brand new customer base, or just having better pricing power in the market. Then there's cost synergy. Think eliminating duplicate head offices or scoring bulk discounts because of economies of scale.
There's financial synergy, where joining forces might actually lower your overall cost of capital or unlock some new tax shields. And lastly, managerial synergy, where a really solid management team takes over a struggling asset and totally turns it around.
Which brings us to Section 4, structuring the payment. How are we actually funding this acquisition?
Okay, so you know the value, you see the synergy. The crucial next step is figuring out exactly how you're going to pay for this shiny new synergistic mega company. We've got a few options. A cash offer is beautifully simple, it's immediate, but it forces the target's shareholders to pay capital gains tax right out of the gate. And, you, the acquirer, actually have to find all that cash. A share exchange means issuing new shares to the target. That's great for them because there's no immediate tax hit, but for you, it risks diluting your earnings per share. Finally, loan notes. These are debt instruments. The target gets a steady stream of interest, which is nice, but you've just loaded up your newly combined balance sheet with a pretty massive liability. So how does the way you pay directly impact your numbers? Specifically, let's talk about post-acquisition earnings per share. If you go with a share exchange, you absolutely have to calculate if the deal is going to be dilutive. Step 1. Add your profit, the target's profit, and, this is crucial, do not forget to add in those expected synergy profits. Step 2. Calculate your current shares plus the newly issued shares that are created by your exchange ratio. Step 3. Divide that total combined profit by the total combined shares. If that new EPS number ends up lower than your pre-acquisition EPS, well, you've got a real dilution problem on your hands. There's actually a golden rule that perfectly anchors this whole concept. EPS impact depends on exchange ratio and synergy, but the PE ratio determines dilution. Basically, if the target's PE ratio is higher than the acquirer's, your EPS is probably going to be dilutive initially, unless those synergies are just absolutely massive. Seriously, write that rule down. It's a lifesaver. Next up, Section 5, the power of real options. This is Phase 3, managing that post-deal uncertainty. Okay, the deal is done. But out here in the real world, the ink dries and a ton of uncertainty is still hanging around. Traditional net present value calculations just assume you're locked in, blindly marching to the end. But real CFOs, they know they have flexibility. We categorize that flexibility into what we call real options. You've got the option to delay. Maybe you wait to see how market demand shifts before you commit a ton of capital. The option to expand. Like, you only open a second factory if the first one is a massive hit. The option to abandon, which is basically the right to pull the plug, sell the machinery, and at least get some salvage value if things go south. And the option to switch, pivoting your entire production mix to use alternative raw materials if your supply chains suddenly get disrupted.
The biggest takeaway here, flexibility literally has a mathematical, quantifiable value. Traditional NPV completely ignores this, but a smart financial manager knows that real options equal the value of managerial flexibility. Because of that, you absolutely must adjust your base NPV upward to reflect all of this hidden value. It's a real game changer. Finally, Section 6, strategy for exam success, executing on exam day. Let's wrap this all up and turn these concepts into actual point-scoring strategies. If you are sitting for the AFM exam, these prep tips are basically your lifeline. First off, please do not question spot. You need to expect absolutely anything. Second, practice using your spreadsheet software. You need serious muscle memory for your NPV and IRR functions way before you sit down in that exam chair. Third, show all your workings. The examiner will actually award you method marks even if your final number is completely wrong, as long as they can follow your logic. And finally, state your assumptions clearly. Valuation is as much an art as it is a science, so you got to tell the examiner exactly why you made the choices you did. To drive that home, expert tutor Andrew Moore has a pretty explicit warning about the dangerous habit of trying to guess what's on the test. He says, anything can get tested. Make sure you're covering the key topics. Think about it. Question 1 might have hedging, investment appraisal, and valuation all mixed together into one giant puzzle. Broad, comprehensive coverage really is your only safety net. But I want you to remember this awesome thought from the study notes. You have the tools. Apply them with confidence. Look, you've learned how to identify synergy, how to structure a payment, you know how to ungear and regear betas, and you know how to value flexibility. The heavy lifting is done. Now it's just a matter of going in there and executing. So I'm going to leave you with this final thought. Are you ready to step into the role of a CFO and execute your first major deal? Take these frameworks, go practice those spreadsheet formulas, and go unlock some serious value. Thanks so much for joining me on this explainer, and keep learning.